I'm Brooke Thackeray. Thank you very much for joining me on Monday, January 25th. Today we're going to take a look at what's to expect on the next week on the economic front and also on the stock market front. Before we do that, though, let's take a look and see what happened last week in the stock market and the economy and where we stand today. So if we take a look at the S&P 500 here, we can see here that once again, we reached all-time highs last week. We did pull back a little bit towards the end of the week, but we're still reached all-time highs. We're still in this upward channel, which is a positive technical aspect for the S&P 500. Volume has dropped off slightly, so we have a little bit of a divergence relative to the price movement between volume and price, but nothing really significant at this point. So overall, the S&P 500 is in its favorable 6-month time period for stocks, and technically it actually is fairly positive at this point. If we take a look at the performance of the S&P 500 last week on a day-by-day basis, you can see here Monday was a negative day. We saw Tuesday being a positive day. Wednesday was the big day. It was Biden's inauguration. The S&P 500 was up 1.4%. Which is a significant move. And really it came down to investors anticipating increased government spending and therefore pushing the market a little bit higher. We did see the market actually pull back down towards the end of the week relative to the high on Wednesday, though. If we take a look at the major markets last week, the big winner was the NASDAQ at over 4%. That really was a technology-based technology stocks driving up the NASDAQ. The S&P 500 came in at 1.9%, which is a strong move in the marketplace. Emerging markets continued to perform well relative to the S&P 500 and came in at 2.7%. The Russell 2000 was just slightly better than the S&P 500. Typically in some weeks when a strong move has happened in the S&P 500, we've seen the small caps actually perform quite well and significantly above the S&P 500. Last week it was just a little bit above. And last week the negative performer there was the S&P TSX Composite Index down 3.35%. If we take a look at the sectors of the market, the big sector winner was the telecommunications sector. And that really was a reflective bounce, a lot of it, from the previous week when we saw poor performance in the sector because of some stuff going on politically, et cetera, and investors said, hey, it's not so bad, came back into the sector, especially since we do see some earnings come out with the sector this week. Technology performed very well. We saw that really a bump that took place, and it really was like investors just said, hey, technology companies are going to be reporting very shortly, in which they are. Let's get back in there and be there for the reports. Now, if you take a look at the industrials, materials, energy sector, the reflationary trade, last week just didn't do that well. In fact, we saw a good performance from these sectors overall. And there really was a shift that was taking place into the technology sector. Now, partly we saw interest rates pull back a little bit, which is supportive of the technology sector, but there's also a repositioning of investors coming into the earnings season where technology companies generally report. Financials. This is an interesting one because the financial sector started to report their earnings on January the 15th, the big U.S. banks. And they reported earnings last week as well. But the financial sector actually pulled back. And if you take a look at the financial sector here, we're using the ETF XLF on the top here. And this panel here is XLF relative to the S&P 500. And let's just zoom in a little bit here for the financial sector. You can see here that in 2021, I'll zoom out a little bit, you can see here that we saw this run-up in the financial sector outperforming the S&P 500. And then on the 14th, it reached this peak relative to the S&P 500 now. They started to report on the 15th. And despite better than expected earnings overall as a group, we've seen this underperformance relative to the S&P 500. So investors have really bought the rumor and sold the news. It's partly also, too, as well, interest rates pull back and the reflationary trade as well. Reflationary trade also too, as well as pull back a bit at the same time. But what we don't want to see for the technology sector, actually we'll just zip back to the, let's take a look at the technology sector here. is the same phenomenon taking place. If we zoom in here, we can see here the technology sector is started to outperform really about the 15th of January here. And then since then, it's performed very well relative to the S&P 500 coming into earnings. And so we see some big companies reporting earnings this week in the technology sector. And so it'll be interesting to watch what happens. Do investors follow what took place in the financial sector and sell off the technology sector on earnings? And we'll talk a little bit about that later on. And if we take a look here at the 10-year Treasury yield, you can see here the 10-year Treasury yield is still in its upward channel here. We have seen this pull back over the last couple weeks, and last week it was down a little bit, pull back as well. So if we see continue to pull back on the yield, this could be important as far as which sectors of the market investors are favoring as well, and also gives you some indication on the reflationary trade. If we take a look at a company that's noteworthy last week, it got some media attention. It's a company called Gamestop, GME. Now, it's interesting because this company is a bricks and mortar retailer of video games. It was trading at below $5 for a good portion of 2020. On Friday, it closed at just above $65. Now, so what's going on here? There's a number of things going on. But at one point last week, the company, the short position on the float was 140%, which is just huge. And so what we've seen in this relatively small company is retail investors gather up on Reddit and other forums to try and force the short sellers to buy back their positions, to cover their positions by buying back the shares, which pushes the company higher. And that's exactly what we saw happening with GameStop last week, which is an interesting phenomenon that we haven't really seen very recently, and particularly in this market here. Last week also as well, Janet Yellen, before the inauguration of Joe Biden, came up with a speech and talked about as Treasury Secretary her intentions. Now, she did say the smartest thing that we can do is to act big. And I'm not so sure if that's the best phrase to use. Investors loved it because it means that more government spending, and which generally helps push the stock market higher in the short term. And, I would have loved to have seen something like, we need to spend responsibly to help those in need in COVID, whether it's individuals or the companies. We need to make sure the right people and the right companies get the spending. But Act Big definitely helps overall as far as the investor approach as well. So what's coming up this week as far as earnings and economic news? We have CN Rail reporting on Tuesday. Microsoft. So Microsoft is a company that's done extremely well over the last few years, pulled back relative to the market recently. We'll take a look at that. Johnson & Johnson. So we get healthcare there. General Electric, 3M. So we look at some of the industrials. Starbucks, AMD, Texas Instruments, American Express. On Wednesday, we're looking at CP Rail. Now, CP Rail is actually one of the focus strategies in my book, my Thackeray's 2021 Investors Guide. Apple. This is a really key one that investors focus on as far as driving the overall market goes. And so this is going to be an important earnings release. Facebook, Tesla, Boeing, AT&T, Abbott Laboratories, Rogers Communications, which is actually a new strategy in my book this year on a seasonal basis that I've included in the 2021 Investors Guide. This upcoming seasonal period is not the strongest seasonal period for Rogers Communications, but something to note. And we have McDonald's, MasterCard, and Visa as well. So big news on the economic front is going to be the FOMC meeting. So the announcement on the interest rate, it's expected that the Federal Reserve will not make any changes to the Fed funds rate. If we take a look at Microsoft, which reports this week, you can see here that on an absolute basis, you can see here that it's been fairly flat really since the summertime, and it's underperformed since July. It's underperformed the S&P 500. We did see that uptick that took place where investors sort of said, hey, Microsoft reports, let's get in there before they report. And investors still want to be invested in this marketplace, and they're looking for companies that they like, that's pushed up the market over the last few years. Now, the underperformance has been because investors really were favoring some of those sectors that benefit from the reflationary trade. And it'll be interesting to see the overall reaction in the marketplace to Microsoft earnings this week. Apple comes out. So lower highs here, all-time high as well. Very positive overall. If you take a look here, its peak really was relative to the S&P 500 at the beginning of September. It has pulled back. And here's last week, we saw investors rush into Apple. It's almost like investors said, oh yeah, Apple is releasing their earnings coming up. We want to be invested. Let's get in there because we could see a move. It has, pulled back a little bit relative to the market. We're not convinced about the reflationary trade anymore so much. It may come back, but right now let's move into Apple. And we saw that phenomenon take place where the technology stocks actually did quite well. Facebook, we've seen the underperformance relative to the S&P 500. And then last week we saw Facebook actually pop back up as well relative to the S&P 500. Tesla, I'm not going to get into the valuations of Tesla, up over 700% this year. But if you take a look here, what you do see is this flat absolute periods where it's flat, where investors actually consolidate coming into announcements. And that's exactly what we've seen here in January. After a few up days at the beginning of January, Tesla's really been consolidating coming into its earnings. It's going to be interesting to see how the market responds to this particular earnings coming up as well. This is a graph from the CME FedWatch tool, excellent website. If you Google CME FedWatch tool, it'll take you to the site that actually tracks investors' expectations on the federal funds rate and what the Federal Reserve will do. For the January 27th meeting this week, right now the tool actually has the prediction that the Fed will 100% stay in the range of 0 to 0.25%. Nothing's ever 100%, but this tool is saying 100%. Nevertheless, it's up in that area. And if you take a look here, if you go along to all the next Fed meetings here and click on the different dates, you'll actually find out that the investors are still expecting at least over 90%, even towards the end of the year, that the Fed's funds rate will stay in this range here of 0 to 0.25% as well. If we take a look at earnings, this is the big earnings week coming up here as well. So really what we're looking here is at the 2020 Q4 earnings. Right now we've got the revenues expected to come in on a year-over-year basis. So that's going back to measure Q4 of the previous year, 2019, is down 0.8%. And also, too, we are expecting to see that the earnings themselves are down 5.7%. Now, this is really the halfway stop between this a downtick and this uptick as far as expectations go. But it's important to note that measuring the QE2 here, this is really on a year-over-year basis. The reason why this is so high is because you'll be measuring against these levels here overall. If we take a look at the earnings expectations from investors and analysts, if we take a look at the analysts' consensus and what's happening so far as companies reporting their revenues and earnings, you can see here, according to Refinitiv, they provide these three graphs here. You can see here that on a revenue basis, 82% of the companies reporting so far have beaten their expectations on revenue. Now, I know the analysts on average play the expectations game and lower their expectations coming into earnings this season. But nevertheless, 82% on a revenue basis is still quite high. And on an earnings basis, it's actually 88% as well. So 88% is quite a high figure. If we continue to see 80 companies beating their expectations, this could be quite favorable for the overall market as well. So right now, we're coming into a busy week of earnings reports right now, and it's going to be interesting to watch what takes place as far as investor reactions to the earnings. So with the financial sector, we saw the sector actually sell off after earnings. And if we see the same phenomenon take place with the technology sector, that could indicate that there's a shift in sentiment in the marketplace where investors are starting to pull back on their bullish sentiment. On the other hand, if the technology sector comes out with strong earnings and the market responds positively to it and runs up, that could actually show that the market actually has some legs to move forward for in the near future and do quite well. So let's take a look at not only what the earnings are, but also to how investors are responding to the earnings of this week. Thank you very much.